Accounting allows organizations to identify how much money is coming in and being spent. Without accounting, there is no way to accurately predict cash flows, raise money for projects, or know if you can afford to purchase equipment or hire new staff. Good accounting also allows for grant applications to be more accurate in requesting funding for projects. Without good accounting, an organization has little hope of effectively expanding and maintaining that expansion. While businesses are organized to generate profit, nonprofits are organized to address needs in society. As a result, nonprofits will issue a statement of activities instead of the income statement issued by for-profit businesses. Since nonprofits do not have owners, there is no owner's equity or stockholders' equity, and there cannot be distributions to owners. Some people mistakenly assume that if an organization is designated as a nonprofit, it cannot legally earn profit. In fact, earning profit, having revenues that exceed expenses, is almost a necessity for a nonprofit if it hopes to withstand such things as unexpected expenses, uneven flow of revenues, a decrease in revenues, rising costs due to inflation, an increase in staffing needs, an increase in the needs for its services, a purchase or replacement of needed equipment, or lastly, other needs since a nonprofit cannot issue shares of stock. Nonprofit organizations may apply to the Internal Revenue Service in order to be exempt from federal income taxes. However, there is one issue: whether a donor's contribution to a nonprofit organization will qualify as a charitable deduction on the donor's income tax return. For example, if you are a church, school, or Red Cross chapter, these are some of the nonprofits that will qualify as tax exempt, and their donor's contribution will also qualify as charitable deductions on the donor's income tax return. However, there are nonprofits that qualify as tax exempt, but their donor's contribution do not qualify as charitable deductions. Examples of these nonprofits include social organizations, chambers of commerce, college fraternities and sororities, amateur sports clubs, employee organizations, and so on. Nonprofit organizations need to follow generally accepted accounting principles, otherwise known as GAAP. These principles constitute preferred accounting treatment. The policies are set primarily by two different entities: the Financial Accounting Standards Board, otherwise known as FASB, and the American Institute of Certified Public Accountants, AICPA. The main FASB pronouncements are also known as SFASs, and the ISCPA pronouncements are known as SOPSs. Under GAAP, the FASB pronouncements are the top-level guidance and take precedence over the IACPA pronouncements. So does GAAP apply to nonprofit organizations? Absolutely. The SFASs and the SOPSs typically apply to both for-profit and nonprofit organizations. There are certain pronouncements that apply only to nonprofits, and certain that they do not apply to nonprofits. In addition, the newly created Public Company Accounting Oversight Board has the authority to issue accounting regulations for publicly traded corporations. There are several differences between for-profit and nonprofit organizations. While the aim for for-profit organizations is to maximize profit and forward these profits to the company's owners and shareholders, nonprofit organizations aim to provide society's needs. Nonprofit organizations have no owners. Instead of maximizing profits, which means maximizing revenues while minimizing costs, they are more concerned with ensuring the revenue is greater than cost. This ensures that the nonprofit can still provide society's needs. For-profit organizations must pay taxes on their net income, but this is not true for nonprofits if they are exempt from taxes. If a nonprofit's goal is to increase the welfare of society, governments tend to help this cause by minimizing the nonprofit's costs as much as possible. It is these differences between the two types of organizations that have an impact on each type's accounting method. When a tax-exempt nonprofit submits their accounts to the IRS, they are only assessed for taxes that are secondary to the organization's scope, such as sales tax or real estate tax. On the other hand, the IRS scrutinizes the earnings made by for-profits, in addition to any secondary taxes. Most for-profit organizations prepare a balance sheet every quarter. A balance sheet lists the company's owner's equity. Owner's equity is comprised of assets, which is everything the company owns, and liabilities, which is everything the company owes to others. Owner's equity has a direct impact on the company's common and preferred stock if applicable. A nonprofit does not use a balance sheet because it has no owners. They will instead compile a statement of financial position, which focuses only on assets and liabilities. Adding assets to liabilities give the company's net assets. Accountants then scrutinize net assets to assess the financial size of the nonprofit. In addition to the balance sheet, a for-profit will prepare an income statement each quarter. The income statement will list the company's revenues, gains, expenses, and losses. The main purpose of an income statement is to assess the company's financial performance on a quarterly basis. This in turn has an impact on the company's value and share price, and company stockholders have a legal right to these income statements. Nonprofit organizations, on the other hand, do not compile an income statement, but instead prepare a statement of activities each quarter. This document simply lists the organization's revenue minus expenses plus their net assets. Generally, there are two methods under which you can do your accounting: the cash method and the accrual method. The cash method of accounting is focused on the inflows and outflows of cash. Much like your personal finances, organizations have revenue when we make a deposit and incur an expense when we cut a check. There is little regard to when the revenue was actually earned or the expense was actually incurred. We just worry about the cash flows. The accrual method of accounting doesn't worry about cash flow and instead focuses on when revenue was actually earned and when expenses were actually incurred. For example, let's say you purchase office supplies in the month of April on your credit card and pay for the purchase in May when you receive the credit card bill. Under the accrual method of accounting, we would record the expense for supplies in April. The other main difference between the two methods is the ability to budget accurately. Accrual method of accounting allows for better budgeting and planning because it looks at when liabilities are incurred and revenue earned and not when cash is paid. This method puts on the books liabilities that might otherwise be forgotten, such as accrued vacation. The cash method doesn't worry about accrued vacation until it is required to be paid. This could create a very painful situation for a nonprofit that hasn't planned to pay out an accrued vacation balance and is now faced with cutting expenses in other areas to have enough cash to pay the outstanding balance. So which method is better to use? The cash method of accounting is the easiest method, but not necessarily the most accurate. If you have paid staff, you should not use the cash method of accounting. Be sure to check your state regulations about this. Some states require the accrual method of accounting to be used. The cash method of accounting is best used by very small nonprofits with no paid staff, no set programs, and little to no plans for expansion. The accrual method of accounting should be used by organizations starting out with large amounts of funding, paid staff, and plans to raise additional funds from larger donors such as foundations or government entities. Generally accepted accounting principles also require the use of the accrual method of accounting. If you wish to have an audit done under generally accepted accounting principles, you should use the accrual method of accounting. Think of the chart of accounts as the backbone of a good accounting system. Basically, the chart of accounts is a list of categories used to group your financial activities. A nonprofit's transactions are recorded in accounts in the general ledger. A listing of the titles of the general ledger accounts is known as the chart of accounts. The accounts in the general ledger and in the chart of accounts are organized based on your statement of financial position and your statement of activity. The statement of financial position has your asset account, your liability account, and your net asset account. And your statement of activities have your revenue and gains and your expenses and losses. The number of accounts in a nonprofit's general ledger could range from 30 to 1,000 or more. The number of accounts depends on the number of programs that the nonprofit has, the type of revenue it earns, and the level of detail required for planning and control of the organization. For example, a nonprofit is likely to have a separate general ledger account for each of its bank accounts. It may also have 50 general ledger accounts for each of its major programs, plus many accounts under its fundraising and management and general expense categories. The detail in the general ledger accounts will always be available for management use. However, all of the account balances will be summarized into a few totals that are represented in the financial statements and the IRS Form 990. This chart provides you with a sample of some of the asset accounts that you might find in a typical chart of accounts. This chart provides you with a sample of some of the liability accounts you might find in your chart of accounts. Accounts receivable are monies owed to the organization by another party. Typically, accounts receivable are recorded when services are rendered to earn revenue for the organization, or promises to give are received by the organization. Promises to give are typically not recorded unless there is a signed pledge card or an award letter stating the amount being promised and an approximate time period under which it will be paid. Above on the chart are some example journal entries for accounts receivable. The receipt of an accounts receivable item is typically reflected in a deposit made to your cash account. When you have accounts receivable, it is vital to review it before assigning revenue accounts to your deposits to make sure you remove any accounts receivable you have so you do not double count revenue. An account payable is an outstanding bill from a vendor that the organization has an obligation to pay. The above examples on the screen show in journal entry format how an account payable is created and how the account payable is removed when the check is cut to pay the actual invoice. Processing payroll is time-consuming and tricky given the various state tax laws. It is recommended that you outsource your payroll processing to a payroll processing firm. They are better able to keep up with income tax law changes and are better equipped to file the proper forms on time. When you set up processing, make sure the processor files both state and federal tax forms for you. Recording payroll is not just showing the amount deducted from the bank account, but all the parts making up that amount. Payroll includes gross salary, federal and state payroll taxes, deduction for benefits, and the final amount withdrawn from your organization's bank account. If an organization decides to offer direct deposit for its employees, the payroll processing firm will pull both the net salary and payroll taxes from the bank account of your organization. If an employee is paid using a check, the payroll processing firm will provide a printed payroll check for the net amount and only pull payroll taxes from the organization's bank account. If you outsource your payroll, you will receive reports from the payroll service for easy pay period. These reports typically contain a payroll register for the current payroll period and a cumulative report that, if set up properly, will show you quarter and year-to-date information. To enter your journal entries for each pay period, you will work primarily from the payroll register. Internal controls are the financial processes and procedures that enable the organization to safeguard its assets. The most effective procedures are those that have the greatest segregation of duties. The more people involved in the process, the less likely it is that an error or defalcation will occur. For example, the person who writes the check should not be the person signing the check. The person who orders the service or product should approve the invoice. The person with budget responsibility should also approve the expenditure and should code the invoice. Generally, management establishes the system of controls. It is helpful to have an accounting manual detailing the procedures to be followed.